Hi everyone, thanks for joining us for the November video update. We're going to have a quick chat about what we're seeing in the current market, some key picks, how we're positioned, and we're also joined by Will Allen, who's the Enhanced Yield Portfolio Manager, Investment Committee member at Endeavour, and he's going to talk a bit about his portfolio at the end. Now, what we've seen in November is a resurgence in global markets. This is mainly due to a moderating economy and easing inflation. The result was we saw our portfolios up between 2.8 and 5.4%. And the reason for this is the past 2 years have been driven by higher interest rates, higher bond yields, higher inflation, but declining inflation. Now, you can see that in this chart here, which is the US 10-year bond yield. Now, this is the market's forecast of where interest rates are going to go. And the reason it's resulted in a tougher environment for equities for the past 2 years is because higher inflation means higher interest rates are required to cool the economy, and the bond yield is an input into valuations for assets globally. So a high bond yield equals a high discount rate, lower valuations, and it's also posed the question, how much will tighter monetary policy impact the economy and subsequently company earnings? What we've seen recently, and it's become quite clear that inflation has peaked. Now, it peaked a year ago in the US, 9%. It's now closer to 3%. And Australia in the red line was a bit later, peaked above 8%, and that's continued to drop since. We think they'll continue to drop into December due to the base effect. This is a year-on-year growth rate, and last year a big number will roll out. So we'll see lower inflation in the short term. And we think this will result in the bond yield continuing to decline and some relief for equity valuations, which was quite clear in November. That has started to play out already. What the higher bond yield and discount rate has done is it's impacted different sectors in different ways. So the Australian market broadly has held up pretty well. We can see here that industrials index has declined from a PE of 22 times to 17 times. Small caps have been dealt with savagely. This is small industrials, we're down 30%. This information is a bit outdated now. This is from a presentation we did to clients a few weeks ago. They've bounced since, but you can see there the grey line, 30% decline in small industrials. The all ordinaries, excluding dividends, was down 7%, including dividends, about flat during this period. Now, this chart in the top right, we can see this is at the moment a soft landing. We've had unemployment stable, slightly ticking up, and CPI decreasing. Now, we think looking forward to next calendar year, the market's actually set up quite well because we think a scenario will continue to play out, which is lower inflation, stable or declining interest rates, improving equity valuations, maybe some shift back from fixed income to equities to capture growth. We're actually seeing earnings for the next calendar year increase. Well, the past 2 years, we've seen earnings expectations decline because investors have been worried about a hard landing. We think the economy is going to perform better than expected, and we think interest rates in Australia will remain relatively stable. Now, over to what this means for the portfolios and some of our stock picks. Some of the companies we're positioned in include Mineral Resources, Worley Parsons, Chrysos. We added that to the portfolio last month. It's trading about 20% higher. They've got a best-in-class technology for measuring gold assays. Johns Lyng is a builder based in Australia, moving into the US. They provide services to the insurance industry. They're looking at a national contract now. That's got quite an exciting outlook. Some quality tech like Altium, we've owned forever. Well, about 7 years. WiseTech similar, Xero. We think they're the 3 best technology companies in the ASX, and Life360 is another recent one. We've got a few slides on this coming up as well. I'll actually just scan through those slides while we're talking about them now. Worley Parsons is a major beneficiary of the global energy transition CapEx cycle. So this is That's a lot of jargon in that line. And what it means is their money will need to be spent to decarbonize the world. And a lot of countries have put out these net neutral targets by 2050. It's estimated there'll be a 4 times increase in capex required. So this is demand for engineering services. Worley has these skilled engineers that can transition into this clean energy space, and we're seeing them win some good contracts early on. Now, this company's performed well for the portfolios over the past 2 years. We still think it has decent upside. Our valuation metrics point us towards 20% upside, but we actually early this month, we have taken some profits. It still remains about our 3rd biggest holding, but we've just taken some profits into the recent rally. But you can see here our target price, our cross-check with our DCF and our multiples valuation gets us to the same mark, about 20% upside, and leading indicators are positive. Their pipeline's up 60% year on year, and the backlog's up 14%. So we think the positive trends will continue. But the reason we've trimmed is we have been taking some profits in more defensives. For example, in November, we trimmed we exited QBE, Computer Share. We trimmed some Worley recently, and we've added more oversold quality like Chrysos, which I mentioned before. We added WiseTech after a 33% pullback in the share price, and ResMed's another example after a significant sell-off. So we're moving the portfolio more into some quality that's sold off that we think can bounce back and outperform these defensive equities that have been a good hiding place for the last 2 years, that have held up relatively well. But now we think there's better performance in some businesses with more leverage to the upside. Altium, that's a business we've owned, as I said, for a long time. We're still confident in the future for Altium. They have a software and a marketplace for designing PCB boards. It links to the manufacturer, links to the parts. You can order parts. The business is called Octopart. All combines together, and the thematic, obviously, we all know the thematic for electronics. That's a big tailwind for this business. AI is actually the next leg up, which we're seeing this year. This chart here is the best chart on the ASX, in my opinion. So you can see the revenue's just compounded every year. They're doing 260 mil rev. They're targeting by FY26 500 mil revenue. They're profitable. 39% margin is their target, and we're confident they'll hit these numbers. So Altium is an easy hold for us. Horizon. This is a quality business. They have value in their assets with, they're a rail operator. They've got 5,000 kilometres of assets, locomotive trains and wagons. It's making 1.4 billion EBITDA, and this dividend yield continues to increase. So this is a high weighting in our balanced portfolio where clients are looking for more yield. Solvar is one that's worth talking about because and we've spoken about this business a few times in these video updates and to clients in one-on-one meetings. Now, this has been a big detractor to the portfolios. One of the biggest over the last 2 years. It's declined from $3.80 to $1.05. Now, they provide financing. If people go to a used car dealer and you're looking for car financing, in the back end, Solvar is one of the providers, and they target a demographic that's paying a higher interest rate. So it's perceived to be risky. The market's dealt with it savagely. We think they'll actually perform well during this economic environment, which is due to soften for reasons that I won't go into now. But we've gone into the head office. We've looked at the software. We see what their customers spend their money on. They're generally lower income, which is their jobs are quite safe and secure. They work in companies like Woolworths and Bunnings, and we looked back at past cycles like the GFC. Solvar's collections actually increased. They perform better during this tougher economic environment because their customer tends to not have many assets. They don't have a mortgage. They're not squeezed by higher mortgage rates. Their car's their primary asset. They need it to get to work. And meanwhile, we're being paid a 12% dividend yield to hold this company. It's trading on 8 times earnings, and we think we'll prove next year that they're more resilient than the market's giving it credit for. So not saying this is going back to the highs of $3.80, but we think it can trade closer to NTA. So $1.50 is our target, trading at $1.05 this month, about $1.11 today. Live 360, won't go into it in too much detail. This is one of our key picks. It's an app used to track family members. It's got 60 million global users. Only 9% of them are paying. There's massive leverage here if they can monetize a user base. And they can enter new markets like insurance, senior monitoring, security. At the moment, it's like Find My Friends on iPhone. You can communicate with your children or your whole family. You can see where they are. It notifies you if they're driving aggressively or too quick. If they have an accident, it can call emergency services. So it's quite powerful. And then they've added in other device tracking services as well with the acquisition of Tile, which was a few years ago. You can see here every year they just add more active users. They're quite sticky. These cohorts, this company will just keep growing. Hopefully this chart demonstrates that. Recent performance trending well, Canada, UK, Australia. Another key pick of ours is mineral resources. So this is quite a diverse business with a lot of optionality. They operate in iron ore. They've got a lithium asset. They run mining services. They operate the mining services for their commodity assets. It's trading relatively cheap. It has good upside based on higher lithium price. If the lithium price bounces, so we like that leverage, but it's not direct exposure to the lithium price because they've got quite a stable business, their core business as well. So I sped through those quite quickly. They're just a couple of key picks in the portfolio at the moment. We've been making some changes recently, which clients will see flowing through, and we're seeing good opportunities in this oversold small cap space. So some companies we're looking at down between 50 and 80% that have gone through a period of readjustment where the market's forced them to focus on profitability, where 2 years ago the market and a lot of companies were focused on growth at any cost because the market was paying revenue multiples, now paying higher multiples for high growth. That whole dynamic's changed with higher interest rates. So there's a return to cash flow quality, which is what we want to see from management teams, and they're the type of companies that get us excited because we can get a good upside to the valuation. So it's quite an interesting time at the moment, and we're confident. We've seen the lows in that space 2 years ago. Really, the catalyst was the Fed signaling that the rate hike cycle is over. So after 2 years of lower valuations and concerns about higher interest rates, that dynamic has changed. So we think we can see a scenario early next year where the economy is softening. It's a bit softer. Inflation's coming off. Interest rates are no longer increasing, and companies have gone through this period of having to focus on earnings and earnings growth. And right now, we're actually seeing earnings expectations tick up for next financial year after 2 years of earnings expectations coming down. So this is quite favourable for equities and especially our world, what we focus on. So that's it. Just sort of a quick highlight of a few companies and what we're seeing and performance in November. And it's probably worthwhile now handing over to Will. So Will Allen has been running an enhanced yield fund. We set this up around COVID where clients were looking for an alternative to cash. I'll let Will tell you a bit about what he does in this portfolio, but from our perspective, we think if you're in a term deposit, you should really be in this portfolio or a similar portfolio because you can get a bit of extra yield without too much extra risk. So Will, maybe do you want to chat about that, what you're seeing? It is worth, I know you don't like to gloat, Will. I think it is worth just talking about your performance since you started this portfolio as well versus the cash rate.
Sure, Hayden. Thanks very much. I was on this, I did this monthly call back in April this year. I thought I did a really good job, but it's taken 7 months to get back on. So I'm going to try and do an even better job this time, and I may even get to the front of the queue and be the first one to chat to you all rather than the last one. So let's see how we go, Hayden. Hey,
don't get too carried away.
It's been a good few years since we started the portfolio endeavour back in September 2019. We rode through COVID unscathed with positive performance. And in the last year or so, it's been even better, of course, with cash rates going up. We capture that immediately. We're generally a floating rate portfolio, so every time the RBA puts cash rates up, that flows through to our returns. Fiscal year last year, we were sort of above 7% after fees return to our investors. And this year, even from July 1st up till the end of November, we're at 3%. Already, with probably another 50 basis points coming in December, so we'll be 3.5% for these last 6 months, which is great. And the good news from that perspective, from an earnings or a return perspective, is the market. While inflation is definitely looks like it has topped and is coming off, the RBA will remain vigilant. The yield curve in Australia is pricing no genuine likelihood of a rate cut, nor for that matter a rate hike for the next 6 to 12 months. So we expect rates to stay around these levels, and that means our returns to you guys will also stay around these levels, which is fantastic. We're about 70% invested in hybrids, which offer a fantastic return on a risk basis. The Australian banking sector is the strongest, literally the strongest in the world, in terms of performance, capital ratios, capital adequacy, etc. The other 30% we have invested in bonds, including corporate bonds, some emerging market bonds, some high yield bonds, and even sometimes some government bonds. So a nice spread there of investments. The money's available on literally at call basis. It's invested in ASX listed instruments only. So if you need the money next day or a couple of days or a couple of weeks, the money is available for you. From I guess from a big picture perspective, the yield curve or the yields in general, I like to take people back to 1990 when rates were around, let's say, Commonwealth government bond rates were around 10%, cash was around 8%. In 94, they went down, they went low, they went back up again. And right from about 1994 till 2020, they trended down to zero. From there, they've trended back up to 4.5%. It's a different world now. We're not expecting them to go up to 10% by any stretch or any means. At the same time, we're not expecting them to go back down to zero. They're comfortable at these levels. We do look like, fingers are crossed, we do look like that narrow possibility, that opportunity of a soft landing is closer and closer than what we ever thought the RBA could get to. So that means we'll probably have yields around these levels for a period of time. The economy will be able to handle that. Equities will be able to handle it as they get used to these sort of rates. And I'll be able to return you guys somewhere between 6.5% and 7.5% year in, year out. It's a great return for what is a low risk or low volatility portfolio. So please give me a call if you want to talk more about it, and I'll fill you in from there.
Good work, Will. Good work with the update. I'm sure clients, maybe some prospects will reach out. Feel free to call any of us to chat about any of the portfolios. So that's it for today. Best wishes for the holiday season to everyone. We'll be working through, except for the days the market's closed. And we look forward to catching up in the new year. Thanks, everyone.
Thanks. Bye.